Hello and welcome to today's Cabot Wealth webinar, Beat the Market with Small Cap Stocks in 2019. I'm your host, Chris Preston, Chief Analyst of the Cabot Wealth Daily Advisory and Vice President of Content here at Cabot Wealth Network. With me today is Tyler London, Chief Analyst of our Cabot Small Cap Confidential Advisory. Today, Tyler will be sharing his thoughts on small cap stocks and why they appear poised for a big 2019. He'll also give you an honest review of what went right and not so right with small cap stocks in 2018 and tell you which two small cap sectors look particularly strong this year. This is an interactive webinar, which means we'll be fielding your questions after Tyler's presentation. So if you have a question, feel free to ask it at any time, and we will try and get to as many of them as time allows once Tyler wraps up. Now, just keep in mind that we cannot offer advice in regards to your own personal investing situation or portfolio. We'll also tell you how to become a Cabot Small Cap Confidential subscriber with a special discount offer reserved exclusively for today's listeners, so stay tuned for that. But first, let me introduce Tyler. Tyler spent the last decade managing, consulting, and analyzing startup and small cap companies. Tyler's small cap portfolios favor a high allocation to stable, high growth companies upon which he layers strategic purchases of higher risk, event-driven investments. He first began publishing his analysis of small cap opportunities in 2009. Since 2012, he has helped his subscribers double their money more than 10 times. Between 2012 and September 2015, his small cap recommendations generated cumulative returns of over 2,300%, including both winners and losers, outperforming the Russell 2000 index by an average of 28% per year. His current portfolio in Cabot Small Cap Confidential has 12 stock recommendations with an average gain of 60%. Tyler holds a BS and MBA from the University of Vermont, where he graduated valedictorian. He's been quoted by U.S. News and World Report and has presented investing ideas and strategies for The Money Show and Bloomberg Markets Live Insights. Long story short, Tyler knows what he's talking about, and especially when it comes to small cap stocks. So hopefully I've pumped you up enough, Tyler. I'll go ahead and step aside so you can talk. Tyler, take it away.
All right. Thanks, Chris. I like that introduction. And thanks, everybody, for taking time out of your day to join us here. So a little bit of housekeeping, just the standard disclosure statement that we are not compensated by any of the companies that we talk about or recommend. And if you act on any of the information that we talk about today, then you are assuming all risk. Pretty standard stuff. So a little more about me, my area of specialization, I focus on pure play small cap companies that have market caps of under $3 billion when I pick up coverage. And I'm looking for stocks that have exposure to long-term growth trends. I'm not a trader. I don't recommend trades, although obviously we're focused on getting into stocks that will go up, soon after we invest. But definitely this is a long-term focused strategy. And in the small cap confidential portfolio, we are not managing money. It is an advisory service, and I do the research, and we publish it and we send it to you, and you decide how you would like to act on it. The portfolio, the small cap confidential portfolio, typically has 10 to 15 high conviction small cap positions diversified across mostly tech, healthcare, with some consumer in there, and every now and then we'll go into industrials or something else. But it's not, we don't get into the real cyclical stuff like oil and gas and precious metals and that kind of thing. We do look for a lot of diversification across secular growth themes within tech, healthcare, and consumer, and strongly advise subscribers to diversify across time. These are small cap stocks, so dollar cost averaging is a good strategy. All right, so let's kick things off here. 2018 was a really interesting year, both good and bad. We got off to a good start. Volatility picked up a little bit in the first quarter, toward the end of the first quarter. But the S&P 600 small cap index, which is the one that I tend to watch the most, it stayed above the long-term moving average line. That is that red line at the bottom on that chart that you see. And we hit my year-end target, which was 1,100 in September. So the index had risen by 17% by September. So that, it felt pretty good. Felt a little bit too good, I guess. and it was. So what happened? At the end of Q3, the Fed seemed to signal that it was going to be quite aggressive with its rate hikes through 2019. Q3 earnings were okay, not terrific. And then the tax cut benefit, analysts started saying, you know what, tax cut was a big help in 2018. It's not going to be so much in 2019. We also have geopolitical concerns, trade tensions, tariffs, some disruption here at home, and stocks were trading near peak valuations. So everything kind of came together. We had been seeing different sectors roll over throughout the year. Toward the beginning of Q4, our most resilient stocks, the FANG stocks, software stocks, small caps, etc., they rolled over, and we just stepped down, 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 multiple breaks below significant technical levels. And then particularly in December, just a total lack of any buying interest at all. The S&P 600 index fell 28% from its all-time high to a low of 794 in December. It did pick up 10% in the last, I'm sorry, it picked up a little bit in the last week, but it was still down 10% on the year. So it was a pretty disruptive time. We all know that. It was, as volatile as we saw in 2008. So it was pretty rough. But 2019, when I started putting this presentation together a couple weeks ago, we were off to a good start. Now we're off to a great start. And that's despite the lingering issues of international trade, tariffs, Brexit. Eurozone is becoming maybe a bigger concern. We still have some issues here at home, although we have averted another government shutdown, it looks like for now. And earnings estimates are coming down. It's not unusual to see forward estimates come down when we roll into the new year, but we are seeing that now again. On the plus side, we still have low unemployment, relatively subdued inflation, and we think a flexible Fed, and stock valuations are off their peak. And increasingly, the outlook is for no recession, at least in the near term, and possibly even if some of those issues can be resolved, growth that is better than being projected right now. So, on the one hand, it's not hard to see one or more of those issues becoming a big issue or something else popping up that we're not expecting. On the other hand, the economy in the US has proven resilient for a long time, and it could keep grinding along, especially if we get help from the Fed. So as always, there's always a little give and take. We want to stay flexible. We don't want to get pigeonholed into any particular trading and investing corner. You got to take what the market throws at you with a grain of salt, take the news flow with a grain of salt, and kind of keep your eyes open. Right now, we're seeing the small cap index pop right back above into the 900 to 1,000 trading range. And I want to talk a little bit more about that trading range in a minute, but we're up 13% year to date. And that seems like a really nice gain until you go back and you look at where we started the year, which was, at quite a depressed level. So my best guess for 2019 for the high end for the S&P 600, and this is definitely a guess. I mean, price targets they're fun to put out there, but they're not something to hang your hat on. But having said that, my best guess is that the S&P 600 index will rise 30% this year. That would be around 15% higher than it's trading as of yesterday's close. And in terms of a number, that puts the 2019 high at 1,100, which is the high from 2018, and also incidentally, my target for a high in 2018. That implies that the index can trade up to a forward year PE of 16.7. That's based on the current 2020 earnings estimates for the S&P 600. I do reserve the right to change that. I'm going to talk a little bit more about that PE in a minute. But anyway, that's what I'm throwing out there, 1,100. So back to that range that I talked about. So we're seeing the small cap index rebound into the 900 to 1,000 range. And in my mind, that's where the index should have paused and found stable ground in Q4 of 2018, but it didn't. It broke through that. And I think that when it did, programs went crazy, traders went crazy. Everybody thought the sky was falling. And that's why we didn't see any buyers step up, because we broke through a support range that had held in the beginning of 2018. We went negative on the year, and well, we all know what happened. But now we're back in that trading range. And so again, you don't want to hang your hat on this, but in my mind, it seems rational to think that we might hang out in this zone, the 900 to 1,000 zone, for a little while, which, again, given my target of 1,100, seems to be a pretty good place to be building positions and accumulating stocks that you want to hold on to and invest more money in over the coming quarters. So, reasons to be bullish on small caps in 2019. I think, Chris, do we have a poll that we want to put out there?
Yeah, I was gonna just try and gauge people's experience level with small cap investing. Here's just a quick poll just to take the temperature on that. Also, just a reminder, you can start sending in questions if you have any about what Tyler talked about so far, or have any just general questions. You can start sending them now, and once Tyler wraps things up, we'll get to those. Anyway, back to you, Tyler.
Okay, thanks, Chris. I'll just make a quick mention now that if you have questions that you remember after the event, we're gonna have my email address up afterwards. So write that down and definitely email me, today, tomorrow, whenever, and I'll get back to you on email if you have a question that we didn't get to today. Okay, so a few reasons to be bullish on small caps in 2019. Okay. The Tax Cuts and Jobs Act, we talked about this a little bit, the positive impact on 2018, less of a positive impact in 2019 when you're comparing year over year earnings growth. But listen, the tax rate for most small cap companies used to be around 32%. It's now 21%. So that's definitely freeing up some capital. It has also reduced the tax rate on large cap companies, which is freeing up cash for acquisitions. And I'm going to talk about that a little bit more in the technology and software space. But kind of the bottom line, the tax rate is definitely helping profitability and M&A activity. Number two, small caps do tend to outperform during economic expansions, and while growth might be slowing some, we're still within that ideal 2 to 3% range. In 2019, we're looking for around 2.3, 2.5%. And in 2020, the current estimate is about 2%. But upside potential to that should those big picture issues, trade, tariffs, China, government shutdowns, et cetera, if the risk of those things being really disruptive can be reduced. And then number three, small caps are really like a levered bet on the US economy, given that most small cap revenue comes from within the United States. That's not to say there's not international exposure. There is, especially in specific names. But if you're taking like a high level view of, say, the S&P 600 small cap index, you're looking at around 80% US revenue. So big picture, small caps are like a levered bet on the US economy, and with GDP in that ideal range, a relatively good environment for these stocks. This is rudimentary analysis at its finest. I just have put up here small cap returns versus large cap returns, annual returns dating back to 2009. And if you look on the right-hand side, you'll see small caps were down 10% last year versus -6 for large caps. In 2017, small caps were up 12 versus up 19 for large caps. The point here is that small caps do tend to outperform over the long term, but we have not had back-to-back outperformance since 2012, 2013. And especially when you factor in the horrid 2018 period, at some point here, we're going to have another 2016 scenario where small caps were up 25% versus 10% for large caps. And I'm not calling for that specifically this year, although my target does imply 30% upside for small caps. I don't have a target for large caps, but again, point is small caps do seem to be due for a year of outperformance. And valuation is attractive. The S&P 600 forward PE ratio right now is about 16.1, and that is well below the range where that valuation metric was for 2016 through 2018, when it was mostly in the 17 to 20 range. So, this isn't exciting analysis, but when you stop and you look at this, and I tend to look at this every week, you do see that when valuations come down and it's a correction and there's not really risk of a recession in the near term, it's typically a good time to be buying, and I think that's what we're seeing right now. Let's see, so trends in stocks. Maybe, Chris, let's go to those poll results just to get an idea of what the results were.
Sure. And the poll was only up for a brief, probably less than a minute, but it looks like we have a pretty wide range, 33% for beginner, 44% intermediate, 24% experienced. So sounds like all levels here. So that's a good thing. That's what we look for.
Okay.
Great. Let me just close this up.
All right. Thanks, guys, for responding to that. It does help us when we're trying to tailor these webinars to the people that are tuning in. So thanks again for that. So as far as trends, as I mentioned, we tend to focus a lot on technology, and within tech, cloud software has been a trend that we've been following for a number of years in the small cap portfolio, basically because it is, in my mind, the biggest tech story out there. Everybody's doing it. We've been doing it for a while, but really we're seeing the positive impacts of this transition to the cloud really across the world. And I'm not going to go into depth on this slide. This one and the next slide are just for you to reference if you want to go back and kind of take some time to study the slide and figure out a little bit more about the definitions of and the respective buckets of cloud computing. What I will say is that there are really three buckets. There's infrastructure, platform, and software. And as small cap investors, we are mostly focused on software and platform, because when you get into infrastructure, you're talking about the pipes and the backbone of the cloud. And those are the really big companies like Amazon, VMware, Microsoft. Most small cap companies don't have scale to be big infrastructure plays. We're talking about the software stocks, platform stocks that make the applications that people interact with on their computers, mobile devices, tablets, whatever. So big picture, the global trend is toward digital economies. That seems like a strong trend. It's been going for years, and there's a lot of investment in that. CIOs, chief technology officers, information officers, these guys are prioritizing investments in the cloud, in security around the cloud, in compliance. There's a lot of dollars being spent and a lot of dollars being earmarked for future investments in these priorities. And we can gain exposure to those through specific stocks that have products in very, very specific markets, which we'll talk a little bit more about in a few minutes. But we can also have limited exposure to trade. So if that's a concern, the average software stock generates less than 25% of revenue from outside of the United States. Obviously, there are certain stocks that are well above that threshold, but there's also a lot, especially for small caps software stocks, that have zero international exposure. And then analysts are generally looking for around 5.2% growth in software spending this year. That's down a little bit from I think it was 5.4 in 2018, but definitely a very, very strong demand environment. And when we look at the group on an individual stock level, we're seeing that the fundamentals of software stocks, small cap software stocks, are improving as the business model matures. It's become a more durable and proven business model. Companies are gaining wider user bases that are more dependent on their software, and that's creating sticky products that are generating high recurring revenue. And when we talk about recurring revenue, we're talking about subscribers that will pay for a product quarter after quarter and year in, year out. And we're not just talking about consumers. It's mostly business users that are buying the high value SaaS solutions. And we also have a larger base of profitable small and mid cap companies. When I was looking at these stocks 3 years ago, a lot of them were not profitable. And now a lot of those ones that we were hoping would grow and gain scale and become profitable, now they are. The downside to that is that there are now limited options of small cap cloud software stocks that are attractive to trade with market caps of under $1 billion. So we have had to make some adjustments there. And there still are some, and I'll talk about a couple, but for the most part, we're seeing stocks with market caps of over $1 billion now. So why invest now? Well, one of the really, really interesting things is if we can have some resolution with China, there is potential for software stocks to expand into Asia if there is a trade deal that can be reached with IP protection. And I'm not going to go into the weeds on this, but it's definitely a potential huge tailwind for the group if that can happen. I don't know what that looks like exactly, but it's something to pay attention to. We've also seen a significant pullback in software stocks, and the trading multiples are now in line with their historical averages. So at the end of Q3 2018, they were pretty elevated, more in line now, so that's attractive. At the same time, the strategic value of a lot of these companies has gone up. So an increase in deal flow over the last 3 years. And as I've been saying, cloud is a strategic priority, and a lot of companies are investing lots of money to snatch up some of the smaller pure play providers. And we had one in small cap, Aptio, that was acquired a few months ago. That's just one example. And Ellie Mae was announced, that company would be acquired. I think that was earlier in the week. So anyway, there's been a lot of M&A activity, which obviously helps with quick gains. So what to look for in stocks, in SaaS stocks? So exposure to secular growth trends, and secular growth trends are generally, trends that aren't cyclical. So again, we're not looking for oil stocks here. We're looking for stocks that have businesses that are not going to rise and fall that much based on what the global economy is doing there. Really point solutions that should have relatively high demand. We're looking for companies that have durable business models, high revenue and profit growth. If they're not profitable, at least they're trending towards profits. We're looking for reasonable valuation relative to their peers and growth, and some insulation from cyclical trends, interest rates, trade, etc. And no stock out there is going to check all these boxes, but these are just the big picture things that I try to keep in mind when selecting stocks for the small cap portfolio. So a couple of stocks that are not in the portfolio now that I like. Actually, having said that, Q2 Holdings is in the portfolio. This one, I think, is the only one that's in the portfolio now that I'm talking about today. We got into Q2 when it was trading for around $24. It's now at $64. That was back in 2016. But as you can see, a pretty nice chart here, despite the rather large hiccup in Q4 2018. Q2 Holdings they sell cloud-based virtual banking software that they sell to small and mid-sized banks, credit unions. We live here I'm in Rhode Island, and Pawtucket Credit Union just randomly happens to be where we financed a car through. They are a client of Q2 Holdings. One of the pros the company is moving up market into slightly larger companies, and it's a pretty good environment for banks to be investing in their platforms right now, given that they have higher net interest margins with rising interest rates. On the downside, we have seen some financial institution consolidation, especially at the small end of the curve where Q2 plays. That's something to watch out for. But the growth numbers are pretty solid. Revenue up hopefully 24% this year, almost 30% next year. EPS growth in 2018 is massive, just because they were coming off such a small base. And at the moment, 2019 doesn't look like a big earnings growth year, but we will know more about that actually after the bell today when the company reports. So put Q2 on your list of things to watch tonight. They report after the bell. Sharp Spring is a fairly speculative stock. The market cap is 125 million. They sell cloud-based marketing automation software for small and mid-sized companies. So these are things like email delivery, lead generation, blog builder, social media, customer response management software. And you might recognize names like HubSpot, Salesforce, obviously. And then Marketo was acquired by Adobe. Those are the big competitors. Revenue growth is estimated to be up 49% this year. You can see the earnings number. It's not a profitable company. The one thing I will say about 2019 estimates is this is a micro cap stock, and I don't know how valuable consensus estimates are, or even if there really are any reliable ones out there. So I wouldn't focus too much on the estimated 2019 numbers. If this stock looks interesting to you, this is the kind of stock that you would invest a very small amount of money in at first and then build that position over time as confidence increases. Earnings are due out in March, so that would be the time to really tune into that. Upland Software, I have a little more confidence in. I've been following it for a little while, a few years, 711 million market cap. They sell cloud-based enterprise work management software. So that does things like plan and manage and execute on projects like IT and workflow, digitization projects. They are led by a guy who was the CEO of Perficient, and he has brought over an acquisition-led growth strategy. So you're going to see little spikes in revenue growth depending on what their acquisitions were in the last year. So in 2018, revenue should be up around 53%, with really nice earnings for a relatively small company, $1.60 in EPS, up 17% in 2018. And then 2019, revenue up 27% with 24% earnings growth. You can see the chart, like most small cap software stocks, and really like most stocks out there, was doing well until the end of Q3. But it has come back strong, which is a good sign. And then Blackline, 2.7 billion market cap, similar chart, broadly speaking, as Upland Software. But Blackline sells cloud-based finance and accounting software, which does some probably really boring activities, financial close, account reconciliation, controls assurance, that kind of thing. But a lot of the SEC filings that we look at are processed and put together using Blackline software. So, for large companies that are looking to automate and streamline operations and pull in vast amounts of data from, Oracle and all the other databases that they have data sitting in, banks, whatnot, Blackline can pull all that stuff in and really streamline that process for them. So it's really an efficiency and automation solution. And revenue growth is quite attractive, 31% this year, 22% next year. It turned profitable in 2017 and should earn around 9 cents this year. So obviously a huge earnings growth rate at 800%, but that's just because it's coming off such a small base. But more normalized, in 2019, 67% earnings growth. And then I put on my watch list a whole bunch of stocks of small cap software stocks that went public in 2018. And here they are. probably going to mispronounce it, but Zora, 2.2 billion market cap. Eventbrite, you might have interacted with them. They have a platform to plan, promote, and launch live events. SurveyMonkey, we've used it a little bit here at Cabot. You've probably received a SurveyMonkey survey before. They went public. Avalara, 2.9 billion market cap. They sell sales tax automation software, which again sounds super boring, but a lot of states are now implementing sales tax collection for online sales. So you don't just, if you don't have to have a brick and mortar location within a state to have to collect sales tax. And that came about because of the Supreme Court decision that overturned a precedent, and Wayfair was involved in that. So you'll read about the Wayfair case. Anyway, so that's an attractive one for a rather, again, kind of a boring niche market, but sales tax automation isn't something that's going to go away. It's only going to grow. And then Tenable is a cybersecurity company. And then, so the second area where we spend a lot of attention is healthcare, and specifically medical technology. We do some biotech as well, but mostly it's medical tech. And quick definition, medical technology, in my view, and most analysts out there, is any technology that can be used in a care setting and or devices with which a patient can be diagnosed or treated. So it covers a lot of different things: devices, implants, drug delivery systems, drug manufacturing equipment, data processing software, connected health IT, software for the life sciences industry. But it doesn't cover things like, it's not managed care. It's not things like that. It's not, nurse staffing, temporary nurse staffing, those kinds of things. It's really quite specific to these technologies, software, devices, implants, that kind of stuff. So why invest? Well, as far as healthcare goes, it's relatively defensive yet high growth. The innovation and product development roadmap is more incremental than disruptive. And you find disruptive more with like biotech, where suddenly you have a compound that can help with some serious ailment. Revenue goes through the roof when that product hits the market. With medtech, it's really more incremental. And that means that we see more gradual value creation in these types of companies, and the stock price appreciation is more gradual on the way up than with biotech. Again, a general statement, but we tend to see fewer stocks blow up in the medtech space than in the biotech space, or implode. And for me, I like to limit risk as much as possible while trying to capture as much upside as possible. So medtech fits pretty well. And attractive M&A potential. So a couple of secular trends that have been, featured a lot in the media that I can kind of identify with, and I think you can too, for medtech, is consumerism. We are all becoming more a part of the decision-making and care process for ourselves and our loved ones. And we also have more control over how and where our healthcare dollars are being spent. And so that is one of the big picture trends that's feeding into medtech. We're also seeing personalized healthcare and personalized medicine in terms of gene research, data analytics, customized prevention, diagnosis, treatment, and drug dosing programs. Healthcare is increasingly based on individual biochemical makeup. And that all, of course, came about through gene mapping. But really, the idea is that with medtech, you can invest in the building blocks of a better healthcare system. And there are lots of small cap stocks that are involved in this space that have really, really innovative and exciting technologies that they can hopefully do great things with on their own, or they can join up with a larger medtech company, Boston Scientific, Edwards, whatever, and still deliver those products to the market. This is just a quick chart of data from JP Morgan showing the absolute performance and the relative performance of what they consider to be med tech stocks. And the point here is just to highlight the capital gains potential and the potential for this group of stocks to outperform the S&P 500. So to make it really simple, blue bars are the absolute performance of med tech, orange bars the relative performance compared to the S&P 500. When the blue bar is taller than the orange bar, medtech has outperformed. And that's what we've seen in most years. So moving on to some medtech stocks, biotelemetry you might be familiar with. It kind of has a big profile out there, even though it's a small company, 2.5 billion market cap. They have three businesses. They make and sell devices. They also sell monitoring services and lab services for clinical research. Really, the biggest chunk of revenue comes from body-worn remote cardiac monitoring devices and remote blood glucose monitors. And most of their business really is the cardiac monitoring. So they have Holter, extended wear, all that stuff. But they also have designed the platform that's behind the Apple Heart Study. So for people that are using the Apple Watch and following their heart rates with that, biotelemetry is kind of the hidden technology behind that. Revenue in 2018 was quite high because of an acquisition. LifeWatch AG was a European-based company. It was their biggest competitor that they purchased, and so that really helped on the top line. In 2019, revenue up. We're looking for 10% with no EPS growth, but again, we're coming off of a big 2018 with a major acquisition, and we'll know a little bit more on February 21 when 2018 earnings come out. But obviously, demand for the stock is relatively high, as you can see from the chart. Big sell-off in December, and then right back up to a fresh high in February. Tactile Medical, I have a typo there. The ticker symbol is TCND. Apologize for that. The market cap is 1.3 billion. They make pneumatic pump devices to manage lymphedema at home. Lymphedema affects more than 5 million people in the US, and more people are becoming aware of it. So the market seems to be growing by about 20% a year. Tactile Medical does a lot of business with veteran affairs, hospitals, but basically their devices help drain lymph fluid resulting from surgery, infection, other types of trauma. But they let people stay in their home or go to work, or obviously it depends on the severity of the situation. But it's really designed to allow people with lymphedema to be cared for outside of the clinical setting. Revenue up 28% last year, hopefully 21% in 2019. It is a profitable company, and revenue growth accelerating to 17% in 2019. A really big day in early 2019. I think that they pre-announced earnings. So look back at that if you're interested in Tactile. Then Inogen is, this is an interesting one. It's actually a larger company than I typically cover, but I started following it when it was much smaller, so I've always remained interested in it. The market cap right now is just under 3 billion, and you can see it's an ugly chart. It used to be a $280 stock, now trading at around 138. It has not taken back off yet, but it's one to watch in my opinion, because Inogen really was the first mover in the compact and lightweight portable oxygen concentrator market. So people that needed oxygen, we've all seen those big tanks. Inogen came out with much smaller tanks that could fit in a normal size bag, which would allow people to, basically be mobile. Significant market size, even though smoking is hopefully a dying habit. What I think is most interesting about Inogen is I think JP Morgan named it as one of their top small cap stocks for 2019. And recently, it was earlier this week, Muddy Waters and Citron issued short attacks. And if you read content through Seeking Alpha, you may have seen this. But basically, what happens is these groups will issue short attacks on companies in the hopes to drive the share price down. They will have taken a position before issuing that research and then cover the stock, hopefully make a profit and move on. We have seen in the past a lot of small and mid-cap stocks go down 10, 15, 20% when these reports came out. But Inogen stock was really kind of unfazed. I mean, they went down when the Muddy Waters report came out, but they've basically held their own. And in my opinion, that tells me that, one, maybe the market is wising up to this type of thing, but also that really nobody holding the stock wants to sell it anymore. So keep an eye on Inogen. Earnings are coming out on February 26th. We're looking for around 40% revenue growth this year and 26% next year, with modest earnings growth next year. And then other medical technology stocks, in no particular order: Inspire Medical Systems, neurostimulation solution to treat sleep apnea; Glaukos, which Mike Centello has covered a bunch in Cabot Top 10, injectable stents for glaucoma, and they've just put out a new and improved version of their first solution. So Glaukos is an interesting one to watch. Nevro, spinal cord stimulation systems for chronic leg and back pain, and then Intersect, drug delivery for ear, nose, throat physicians. And that is all I have.
Great, thanks, Tyler. I'm going to give Tyler a minute to catch his breath before he starts answering some of your questions. And again, if you haven't asked one now is the time to do it. In the meantime, well, first, let me send out, do one more quick poll. In the meantime, I'm going to tell you how you can sign up for Tyler's advisory. If you like what you've heard from Tyler so far today and are interested in what other stocks he's currently recommending, you can subscribe to his Cabot Small Cap Confidential advisory by going to cabotwealth.com/small cap webinar. Well, let me pull down this poll so you can actually see the link. Close the poll out. Here's the link, cabotwealth.com/small cap webinar. And for today's listeners only, we're offering you a starter subscription at half the normal price. And what you get is a new small cap stock pick every month, regular weekly updates on all the stocks in the portfolio, frequent special bulletins on news affecting those stocks, and it's all straight to your email inbox. And again, Tyler's portfolio currently boasts an average gain of 60%, which is no easy task given what just happened to the market and small caps in particular in the fourth quarter. 3 of Tyler's current open positions have more than doubled, including 2 that have more than tripled. Past winners include a 126% gain in Axogen, a 75% gain in LogMeIn, and a 54% gain in MyTech Systems. So if those sound like the kinds of market-shattering returns you're looking for, I highly recommend you subscribe to Tyler's advisory now and at today's very special price by, again, going to cabotwealth.com/small cap webinar. And the next monthly issue, by the way, comes out Friday, March 1st. And before we get to your questions, let me just share the results of the poll we just did. Looks like 40% of you have had small cap stocks that have at least doubled, so good for you guys. And 34% of you have had stocks that have gone up at least 50%, and 26%, there's a lot of percentages, have gone up at least 25%. So those are some good results. And again, that's doubling, stocks doubling is what Tyler strives for in all of his recommendations. All right, let's get to the questions. Let's see. start off with a question from Susan, who emailed earlier. Actually, she says, Tyler, can you please comment on Array ARRAY Biopharma?
Yes. Thanks, Susan. I'm going to just change the screen here, hopefully without screwing this up, so that you can see what I can see. Okay. So what you're looking at now is just the institutional level research platform and stock charting platform that we use. So Array, well, you're looking at a whole bunch of different things here, but if you can follow my cursor down here, we have a fundamental block, and I'm on the sales change line here. So I think the interesting thing about Array is that their revenue growth is pretty significant at 44% expected to be 44% in 2019 and 32% in 2020. At the same time, if we go up a couple of lines, EPS growth is solid. It still is not making money, but it's solid improvement. And I wouldn't hesitate based on these fundamentals. When we go to the actual, what Array does, they develop small molecule drugs that regulate target proteins to treat cancer, inflammatory diseases, and they have a whole bunch of different things in the pipeline. They have products that they sell on their own, but they also have collaborations, which I think is interesting. If we go to a daily chart, so just take a second. The program is fairly memory intensive. Obviously, you all have charting software at home that you probably use, but this is a daily chart of Array, and we're looking at a big cup with handle here that they came out of in the beginning of January, and they stepped up, and then, as Mike would say, they blasted off into a whole new trading range. So pretty strong technical signal here, backed up by what seems like good fundamentals. I think it's a good looking stock. I think it's an interesting story. Has a good banker in JP Morgan, 4.6 billion market cap. I like it. I think it's a good stock to own. As with any biotech, I think it's a good idea to be averaging in as the story improves.
Thanks for the question, Susan. Let's go to a question from Ken. Ken asks, what are the absolute performance indicators that you look for in a small cap equity?
Okay, thanks, Ken. So we kind of just went through it. Mainly what I'm looking for is when my process is I'll go through a whole bunch of stocks every month of new stocks. I'll screen for a bunch of stuff, and then I'll pull those over, create my watch lists, and then I'll go down through, and the first secondary screen really isn't fundamental. It's just, do I understand what their target market is and what the business is and what are they doing? If I like that, it goes on to the next bucket. Then I'm really looking for revenue growth and earnings growth. And ideally, both trending, in the right direction. There can be some, I will let a company in that's had a quarter or a year of decelerating growth if there's a good reason, like an acquisition that made year-over-year comparison hard to surpass. But at a high level, revenue and earnings growth, or at least trending in the right direction with some sight towards profitability. Then when I'm done with that list I go over, and I make sure there's no weird ownership structure, and not a huge amount of debt. We're looking at high growth software and technology stocks. There really shouldn't be much, if any, debt. So that's the next step. And from there, then I go kind of deeper down into the weeds where I look at things on a product level. And that's all the research that I put in the small cap confidential issues. Kind of go through the whole, product lineup, um, what the technology is, what the risks are, all that kind of stuff. But that's really the process. It starts with big picture. Do I understand the company, revenue growth, earnings growth, make sure there's no red flags in debt and ownership structure, and then get into the weeds a little bit more.
Thanks for the question, Ken. Let's go to Elizabeth. Her question is, are you concerned about the relatively low trading volume for most of the stocks you mentioned?
As a general rule, no, because it's all relative to the number of shares that are outstanding. So it's hard to talk about it without looking at a specific example. But for all of the stocks that I formally recommend, I do write up a section in the report on trading volume and make sure that there's no red flags there really. But for a lot of the companies that we're recommending, if it has a market cap of $2 billion, it's trading volume is just by nature of the size of the company on dollar terms is not going to be that significant. One thing I will say is that, let's go back to Q2 for a second. A lot of these are youngish companies, and if in particular ones that have just recently gone public within the last 6 months or a year, you will see early investors holding on to some shares after the company has gone public. So there might be a lot of shares that are owned but aren't publicly traded until those early shareholders release those shares to the public market. And so I do like to see an increase in trading volume over time, especially as it relates to an increase in the share count from early investors putting more shares in the market. And I have to be clear, I'm not talking about companies that are issuing secondary stock, which that's a whole nother different thing. But anyway, point being, relatively low trading volume to me, so long as it's in line with the size of the company and the number of shares outstanding, is not a red flag. But I go through all that when I'm looking at the ownership structure and the debt and all of that stuff.
Thanks for the question. Here's another one. What level of debt are you comfortable taking compared to cash flows? I guess that in terms of the company, I guess that's what he means.
Yeah, no, cash, debt to cash flow. That's one of those fundamental analysis metrics that I actually don't have to use that much, because most of the companies that I'm following don't have any debt. So I don't really have a hurdle. Yeah, that's the short answer. I will say that when we have a company that has debt or that is issuing like convertible or something like that, obviously we look at that, we study it, we write it up, and we talk about it relative to that specific company. If there's a company that has debt from, I don't know, some event in the past, maybe an acquisition, or maybe they were owned by a private equity company and they were levered up and they're going to have to unload that by issuing new stock down the road. You kind of can wrap your mind around that when you look at that particular company. So short answer, I don't have a general threshold because it's really so company specific, and most of the companies that I'm looking at really don't have significant or any debt.
All right, I think we have time for a couple more questions. Here's one from Jacob. Are there any international small cap stocks that you like?
Yeah. So, well, one that I've had my eye on Um, oops. I think this is going to be an ugly chart. The company is Mix Telematics. So this isn't like my favorite international small cap stock, but it's one that we followed in the past. So Mix Telematics sells telematics solutions, so like tracking software, fleet and mobile asset management software, and it started in South Africa, but it has branched out around the rest of the world. But they're still, I think the CEO is based in the U.S., but they still report in the rand. They're based in South Africa, but it's an interesting company. The growth has been pretty stable, and it is profitable. You can see from this chart, we're still on the daily chart. There's been some pretty significant drawdowns followed by big pops, and it hasn't really managed to break out. Like a breakout above 1920, and holding on to that would definitely be a good sign. Mixed telematics is one. Let's see. Talend. Talend Software is another. The stock's kind of in the doldrums right now. They're a France-based big data provider. Their solution is a big data solution, basically an integration solution for big data. I could see them being a potential acquisition target. I didn't really follow the news release for why the stock fell so much last November, but I think that's one to watch. Especially what we've seen a lot with these stocks that really tanked in Q4 and then have international exposure is they've started to kind of come back a little bit, and then on a good earnings report they'll pop. A little bit of a relief rally, and I think when you see that, that's your signal to dig a little deeper into the story, and then decide whether to make an investment or not. But I guess those would be two: Talend and Mixed Telematics, for like really high levels of international revenue.
Okay, last question from Randy. I'll give Randy the last word. What are your thoughts on Cutera, CUTR, ticker symbol? It's a medical device company.
Yeah, thanks, Randy. I've looked at Cutera. I haven't looked at it in a little bit. I'm guessing, did they just issue earnings? Up 7.8% today. So Cutera develops laser and light-based systems for minimally invasive aesthetic procedures. Revenue breakdown is 62% US, 12% rest of world, 11% Japan, 15% from everywhere else. But basically, it's cosmetic surgery. So products use pulsed light, laser applications, or both, combined with control system software for hair removal, wrinkle, pore reduction, resurfacing, and treatment of skin texture. Market cap is quite small, 217 million. I'm going to go, obviously the chart doesn't look great other than today, but I'll go to the expanded year over year fundamentals. This will take just a second. So Randy, I guess the big question here is Cutera was growing at a 20% plus clip, and so yeah, 2015, 16, 17, they're going to 21%, 25, 28, down to maybe 6% in 2018, and then 6% in 2019. We're also looking at a reduction in earnings per share from 43 cents in 2016 to up to 93 cents in 2017, back down to 36%, or I'm sorry, 36 cents in 2018, and then 42 cents in 2019. So I don't know the whole story, but obviously there's something going on a fundamental level that appears to be bigger than an acquisition resulting year over year tough comparable. So I think you really got to dig into that, and I can do a little more work on that. And on that note, anybody that wants to send me an email, if you had a question, my email address is tyler@cabotwealth.com. Just shoot me an email, and I'll do my best to answer your questions. You know, having said that, I obviously can't give individualized advice, but if you have questions that we didn't get to today, definitely don't hesitate, especially like today and tomorrow and Friday. I'll try to get back to everybody, you know, within 8 hours or so.
Well, thanks for all the great questions. We're right at an hour, so let's go ahead and wrap things up. And thank you, Tyler. Any last words of wisdom to anyone, or are you all talked out?
Pretty much talked out, but I just, you know, I guess to wrap up, just to thank everybody for taking an hour out of, you know, what is probably a busy day for everybody. To talk about stocks, we love doing it. We love looking for them and trying to get the best research we can into your hands and help you find, you know, exciting opportunities, whether that's, you know, small caps from me or trading opportunities or whatever from Mike and the rest of the crew. So just thanks again for tuning in, and we appreciate it.
Yep, and thank you, Tyler. And again, thanks for the questions. And we'll be back next month on March 20th, to be exact, with another webinar, this time featuring our resident growth investing expert and market guru, Mike Santolo, who Tyler mentioned a couple times. So stay tuned for more details on that. Until then, for Tyler London and the entire Cabot Wealth Network team, I'm Chris Preston, and see you next time.